What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today we're going to talk about something called pass-through entity taxes. Sometimes you'll hear this referred to as PTET, for the acronym for pass-through entity tax. So let's start by defining what exactly is a pass-through entity. So a pass-through entity refers to a business structure that doesn't pay federal income taxes at the entity level. So instead, the income's passed through and allocated to the owners who pick it up on their personal returns. So generally this would be one, the most common is a sole proprietor. So that's your Schedule C or even an LLC taxes as a sole proprietor. A partnership or an S corporation. Partnerships and S corporations both pass through income to the owners on a K-1. Now for purposes of the state level pass-through entity tax, because that's what we're dealing with here. It's taxes paid at the entity level for the states. In this case, we're only talking about partnerships and S corporations. Sole proprietors are not eligible to make this election. So what happened is the pass-through entity tax, it's a workaround to the state and local tax deduction cap of $10,000 on your personal return, sometimes referred to as the SALT cap. So this was put in place with the Tax Cuts and Jobs Act back in 2018, which limited the amount individuals can deduct on their personal return for state and local taxes. That limit is $10,000. So this really impacted a lot of high income earners and people that live in states with a high state income tax. So the pass-through entity deductions were put in place by many states. Most states now have one. Not all of them, but most. So this was put in place as a workaround to help these businesses out. It makes the taxes deductible at the state level. So owners of pass-through entities, the entity can make an election to pay the taxes at the state level to help avoid this $10,000 SALT cap limit. So basically, an election's made each year. Pass-through entity, so in this case, either a partnership or an S corporation, will make an election on its return to participate in the pass-through entity or PTET program for that tax year. And generally, that election is irrevocable. Once you make it, you are stuck with it for that tax year. Now, most states allow you to change year by year. You can make it one year and not make the election the following year, but it's irrevocable for that year. So if you make it, generally, you're not going to be able to go back and amend to undo it. Then the entity pays the state income tax on the business income for that year directly at the state taxable rate. So usually most states, what they do is they pick their top marginal tax rate and say, this is the amount you're going to pay. Whatever income the entity has, the tax for the state will be assessed at that top marginal rate, and it gets passed through to the individual owners as a credit. So the entity owners receive a credit or some type of adjustment of state tax return. So typically you're going to see this as a credit because the entity paid the tax on their behalf. So it passes through as a credit as if they made the entire payment themselves on their personal return. So the owners will pick up their share of the entity's income on their personal return. There's an adjustment at the state level for the pass-through entity tax paid by the business. So this is a deduction for federal purposes only. Paying the state level taxes at the entity level. There's a deduction for those taxes paid at the federal level. And then it's added back at the state level. That way, essentially, you can't double dip. And then the credit on the owner's return prevents them from being double taxed at the state level. The entity's already paid the tax, so that it's picked up as a credit on their return, similar to as if they made the payment themselves. But because it was paid at the entity level, that state tax is a deduction for federal taxes. So basically, the income they receive on their K-1 is going to be lower by the amount of taxes paid on their behalf. So the benefits of the pass-through entity tax election, basically, we already talked about, it's a workaround to the SALT cap limit of $10,000. So essentially, if you are in a high tax state or high income earner where you're already limited, you're maxed out at that $10,000 level, making this election and having the entity pay the taxes essentially means you're deducting more taxes than the $10,000 limit overall when you kind of look at the entity and your personal return. There is some flexibility. So most states allow you to make the PTET, or most states allow the PTET election to be optional, meaning you don't have to do it. You can kind of analyze things at the owner level and see what's going to be most beneficial. And then, as we mentioned, the owner generally sees a credit for their state personal income tax return, ensuring they're not taxed twice on that business income. So let's look at a brief example of how this would work. So we're going to use Virginia. So that's where we're based. And Virginia now participates in the pass-through entity tax program. So let's just say there's a partnership in Virginia that has $1 million of taxable income. The owners in Virginia, they're subject to Virginia taxes. The income is Virginia source. So the entity is going to elect to pay the taxes under Virginia's PTET program. Virginia imposes an entity level tax of 5.75%. So that's their top marginal rate. So the partnership will make a payment. They're going to pay $57,500, 5.75% of $1 million, in taxes to Virginia, and they'll take this as a business expense on their federal return. So that's going to lower the partner's taxable income by $57,500. The owners will report their share of the income on their personal returns and receive a credit for their portion of that $57,500 paid to Virginia. So the way this type of setup reduces the owner's federal tax income without worrying about the SALT cap limitation. And at the state level, the deduction's added back to the federal income. So then at the state level, they're going to pay tax on that amount. So in this case, we had $1 million taxable income before the credit. They pay $57,500. That's going to reduce their income down to $942,500 for federal taxes. But at the state level, Virginia, they would add back the $57,500 and still pay Virginia tax on the full $1 million. Now, some states do have additional rules for non-resident owners. There might be a different way the credits work or some withholding requirements. So yeah, it's important to look at this for each state or whatever state you're dealing with. They're not all going to work exactly the same, though there's a lot of similarities from state to state. Now, the IRS did issue a notice in 2020. So IRS notice 2020-75, clarifying that the state and local income taxes paid by a pass-through entity under an elective pass-through entity tax program are deductible by the entity for federal tax purposes, regardless of the SALT cap limit on individuals. So this is allowed. Not all states actually got the program up and running. There's still some working on it. Others, it seems like every year a few more states get added to the program or create their own program. So again, important to evaluate the pass-through entity program and how it will impact all the entity owners for your particular entity. Things that can play into this are the owner's states of residency and their overall tax situation. You want to consider the interaction of the pass-through entity tax credit and any other state-specific credits. Sometimes there's interactions in there that may reduce or enhance the benefit depending on how the credits work together. And this is all going to be very state-specific. So it's important to work with a tax professional to make sure you get this all right and you take the best advantage of the program if your state offers it. Anyway, that about does it for today and our discussion on the pass-through entity taxes paid at the state level for partnerships and S corporations. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Till next time, have a great day.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's ThePulicegroup.com/contact.